Hi, I'm Steve Brice, Standard Chartered's Global Chief Investment Officer. 2025 played out largely as we expected. Strong full-year returns, albeit with significant volatility along the way. Contrary to initial concerns in some quarters, the so-called Liberation Day tariffs did not push the US into recession. Indeed, US interest rate cuts gave markets confidence that the US economy would achieve a soft landing. Despite a slowing labour market, investment in AI continued to surge and remain the dominant equity story. This led to a positive backdrop for investors who rode through the volatility, with our balanced and growth strategies generating 17 and 20% returns respectively, while the income strategy was up over 11% in 2025. So what lies ahead in 2026? Well, optimists argue equities remain in a bull market supported by strong AI-driven earnings growth, high credit quality and growth-supportive policies. On the other hand, pessimists warn that valuations look stretched, inflation could limit the ability of central banks to ease policy further, and rising debt levels may push bond yields higher. Our base case is the US economy will achieve a soft landing, and major asset classes, especially equities and gold, will continue to rise, albeit with the risk of volatility along the way. With that in mind, our outlook for 2026 centres on three themes. First, we expect equities to keep trending higher, led by earnings strength in the US and Asia ex-Japan. While valuations, especially in the US tech sector, remain a concern, we see support from the AI theme, potential rate cuts, and a weaker dollar. To manage this, we favour diversification, overweighting both the US as well as Asia ex-Japan. From a sector perspective, we balance our tech exposure with a positive outlook on healthcare and utilities. Second, we prefer emerging market bonds over developed market bonds. Emerging market bonds offer higher yields and improving fundamentals. And third, we expect ongoing demand for alternative assets, especially gold. A weaker US dollar, central bank buying, and gold's inverse relationship with yields are strongly supportive factors. In 2026, we're watching three key risks that could impact our investment outlook. Firstly, the possibility of disappointing developments in artificial intelligence. Second, a credit event that raises concerns about widespread default risk. And third, any obstacles that prevent the US Federal Reserve from cutting interest rates as expected. Staying aware of these risks will help us make better investment decisions in a changing environment. Thank you for joining me for this Signature CIO strategy update. I'll be back with more updates soon, and I look forward to seeing you then.